First, what exactly is stop-loss hunting? When retail traders assess market conditions and enter a trade by taking a buying position at a specific point, they place their stop-loss at a strategic level. However, operators can target these stop-losses by increasing selling pressure in the opposite direction, pushing the price downward and triggering all the stop-losses set here. The greater the number of stop-losses below, the quicker the market shifts in that direction, leading to sharp downward movements and the formation of very large candles. This phenomenon is known as stop-loss hunting. But why do these operators engage in stop-loss hunting? Let's understand this. In any market condition, stop-loss hunting is mainly used by operators for three purposes. First, to generate liquidity in the market. Second, to free up wallet space in the market. And third, to sell the option premium at a higher price. Now, let's break down these three purposes in detail. But before we continue, if you find this interesting, smash the like button. And if you're new here, make sure to subscribe and turn on notifications so you never miss our new uploads. I'll see you right after the intro and disclaimer. First, let's break down market liquidity. Two kinds of participants exist in the market. On one side, the largest pool of capital belongs to big institutions, such as major banks and hedge funds. These entities handle their own funds along with the money of other investors. On the opposite side, retail traders like you and me participate with smaller amounts of capital. These large institutions or operators usually sell options, while retail traders are the ones buying options. If a retail trader wants to earn in the market, they trade any option, whether it's a call option or a put option. For instance, when they purchase the option premium at $50 and sell it for $1, they act as a retail option buyer. Here, retail traders gain a profit of $1. In the same way, retail traders buy options. But conversely, option selling securing a profit of $1. This shows that a retail trader buys an option at a lower price and sells it at a higher price, whereas an option seller sells at a higher price and repurchases it cheaper. To be a successful option buyer, you must start thinking like an option seller. An operator requires liquidity to place sizable orders in the market. Market liquidity implies that if one party sells an option in 100 lots, another party must simultaneously buy that option in 100 lots. Only when both sides are balanced, buy and sell orders in the market are completely executed. For example, if you check this call option premium chart, operators have placed 500,000 limit sell orders for this call option at a price close to 100. Until there are enough buy orders for call options at this point, those 5 lakh orders cannot be completely executed. Hence, operators create artificial moves in the market on the bullish side. Retail traders begin purchasing options, assuming the market is heading upward. As they enter, their stop losses are positioned below these levels. Watching the market climb gradually, more retail traders buy options at different points, pushing call option premiums higher along with price. From $1 to $2, retail traders dominate in number, yet their capital remains small. Operators are fewer in count, but they control large capital. As soon as the call option premium nears $1, the call selling orders from operators begin triggering, pulling the price slightly down. Observing this fall, buyers who entered from lower levels see their profits reduce. Some retail traders exit voluntarily, making prices drop faster due to excess supply in the market. Retail traders who had placed their stop losses at these points get triggered here as selling pressure grows, and the price rises sharply. In this way, to generate liquidity in the market, operators target the stop losses of retail traders, enabling large chunks of their orders to be executed. Let's now examine some live market examples to see how option premiums are sold at higher prices by creating a market trap during a stop-loss hunt. This is a 5-minute time frame chart of Nifty 50. The market stayed within the same range for the entire session, which is why many traders might not have attempted entries on either side that day. The market showed neither a major breakout nor a breakdown. We describe this scenario as a low volatility market because price action stayed within a maximum of 70 to 80 points throughout the day, limiting the participation of retail traders in entering and exiting positions. Yet, if we observe the overall market trend on this day, it appears negative since the market never crossed this resistance line, meaning, All the put option buyers or call option sellers who entered here on this day had their stop losses secured around this area, which remained intact. On the following day, the market opened slightly gap down. Traders who had positions from this level were still in profit. However, for the market to move decisively above or below this point, liquidity was required, which meant retail traders' stop losses positioned near resistance had to be triggered. Hence, a sharp bullish move occurred, and once those stop losses were hit, traders were forced out of their positions. After that, with no further stop losses left at that level, price consolidated here for a while. To draw retail traders back in, candlestick patterns were formed on the chart. Observing this price action, many retail traders placed put-buy positions here, assuming the market would surely decline this time, taking resistance from the prior level. Thus, their stop losses were positioned above. After a short while, price moved downward, and the stop losses of the traders who had just entered were also triggered. At this stage, many of you might be questioning this movement. You may wonder why the stop losses needed for the market to push higher would be situated above, yet the market fell instead. To explain why the price dropped instead of rising, you must analyze the options premium chart. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this November 1st. This isn't just another course, it's a complete system to master smart money concepts, manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500, plus 61% off for pre-bookings before November 1st. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. The Nifty 50 spot chart is currently trading around the 24,500 level. Therefore, we will analyze the monthly expiry premium charts for call and put options at this spot price. When the price first starts to decline after the market opens, call option premiums begin to fall, while put option premiums start to rise. If operators want to push the market lower from here, they will need to trigger the stop losses of retail traders placed below this point. Only when these orders are executed will the operator's sell positions be fully filled, allowing the price to move further downward. However, since the market is already falling, no retail trader is willing to buy call options. As a result, operators are unable to get the liquidity they require. Additionally, if operators attempt call selling, they will likely earn less profit because call premiums are already trading at lower levels. Since these premiums have declined, selling calls here is not a highly profitable opportunity. For this reason, operators look for other options available in the market to build a wallet. Large bullish green candles are then formed to drive the price upward, causing call option premiums to rise sharply. As the price climbs, all the stop losses of put buyers are triggered, forcing them out of the market. However, for the market to continue moving higher, additional retail stop losses must be placed at the upper levels. Only then can the market sustain an upward move. Yet, for the past 2 to 3 sessions, the price has not attempted to break above this resistance. As a result, due to the absence of sufficient retail stop losses and lack of liquidity for operators to place their orders, the price, instead of breaking upward, begins to drop below the resistance line. Stop losses remain concentrated at lower levels. Therefore, bearish price action is deliberately created on the chart, encouraging retail traders to open short trades under the belief that the market will break this resistance and fall further. Once the price dips, the stop losses of those buyers who had entered earlier are also triggered by a long wick red candle. This forces them out of the market. From here, when the market rises, it does so at a rapid pace. This shows that very few retail traders manage to enter at these points, resulting in very few traders placing stop losses on the downside. Therefore, if the price attempts to move further down from this area, the limited number of stop losses below causes the market to reverse quickly and surge upward, triggering all the stop losses above. However, you might wonder why the previous upward price move only reached a certain level. Let's understand this. When the price first tests this resistance, the number of stop losses placed by the previous day's retail traders is relatively small. Many of these retail traders, noticing the price moving upward again, close their positions early, which prevents the market from gaining the liquidity it requires. As a result, instead of moving higher, the price stays near resistance. To draw retail traders back into the market, Long upper wick candles are formed at this resistance, signaling bearish price action while preparing for an upward move. Believing the price is about to decline, many fresh retail traders place their stop losses above this area and open short trades through put options. If you observe carefully, during the first drop, the premiums on put options did not rise significantly. However, during the second sharp fall, option wallet premiums increased considerably, giving operators a chance to sell premiums at a much higher price, generating bigger profits. When the price once again moves toward this resistance and stalls for a while, many fresh retail traders, seeing the red bearish candles, either average down their older short positions or initiate fresh shorts in larger quantities. In doing so, all these retail traders place their stop losses slightly above or around this resistance, allowing the market to target and hit a larger cluster of stop losses than before. Once the resistance line breaks, many call buyers enter long trades, adding strong buying pressure and pushing the price higher without resistance. This is how operators create wallets in the market. Through this process, they secure the chance to sell options at elevated premiums, which results in substantial profits. Option selling delivers strong returns, and that is why I always remind retail traders in my videos. If you want to be successful in option buying, you need to think like an option seller. Only then will you be able to identify their strategies and follow their moves. That's it, traders. Thank you for watching this video. Every master was once a beginner, but the difference is, they never stopped learning. If you learned something useful today, give this video a like, it really keeps the channel going. And if this is your first time here, don't forget to subscribe and press that notification bell, so you're always updated when I drop the next lesson. Keep pushing forward, keep believing in yourself, because success is built step by step. Thanks for watching, and I'll see you in the next video.